Hey everyone, Longacres Finance here, and it's time to talk about the undervalued Dividend Aristocrats for June 2021. The Dividend Aristocrats are an elite group of companies that have grown their dividend payments for at least 25 consecutive years. They are high-quality companies that fit any dividend portfolio. But what's better than a Dividend Aristocrat? A Dividend Aristocrat that is also undervalued. Because price is what you pay, but value is what you get. Dividend yield theory is a quick valuation method that can identify potentially undervalued stocks. The premise is simple. If the current dividend yield is higher than the trailing average dividend yield, a stock is potentially undervalued, and vice versa. What this valuation won't tell you is why a stock is undervalued. This could be related to many reasons, such as bad news, a poor earnings report, poor guidance, or it could be a result of a deteriorating business. This is why quantitative valuation techniques like dividend yield theory can only take you halfway in the valuation process. Now let me show you which 12 Dividend Aristocrats are undervalued right now, and 8 more that aren't too far off from being fairly valued. Up first is Clorox, ticker symbol CLX, and they are 1.36% undervalued right now, based on their current dividend yield of 2.53% versus their trailing dividend yield of 2.49%. The stock had a strong run during the pandemic, peaking in price in July of 2020 at around $236. Since then, the price has been on a downward trend, finally reaching a fair value in May of 2021. Investors today are presented with a much more attractive dividend yield of 2.53% versus a sub 2% dividend yield a year ago. Up next is Becton Dickinson & Company, ticker symbol BDX, and they look to be 2.88% undervalued right now. The stock offers a dividend yield of 1.39% versus a trailing dividend yield of 1.35%. The stock has been hovering around fair valuation over the past few years, on occasion moving into overvalued territory. Their dividend yield hasn't crossed above 1.4% since late 2017, but it appears we may be presented with such an opportunity if the price pulls back some more this month. In the prior month, the stock was 1.53% undervalued, so this month it presents a more attractive price. Up next is Hormel, ticker symbol HRL. Hormel appears to be 2.95% undervalued right now, with a dividend yield of 2.01% versus a trailing dividend yield of 1.95%. The stock has offered a 2% or better dividend yield for all of this year, but that yield has been trending downward, with some modest share price appreciation. A 5.15% dividend increase early this year was a rather low increase for Hormel, that has managed double-digit dividend growth during each of the last 4 years. Up next is AbbVie, ticker symbol ABBV, and they are 4.13% undervalued right now. AbbVie offers a solid 4.63% dividend yield right now, versus a trailing dividend yield of 4.44%. Based on dividend yield theory, the stock has been undervalued since 2019, with one exception in December of 2020, when the share price spiked quickly. The share price today is higher than it was in December of 2020, but a 10% dividend increase this year has boosted a dividend yield, helping keep AbbVie undervalued. Up next is Exxon, ticker symbol XOM, and they look to be 8.26% undervalued right now, with a dividend yield of 5.6% versus a trailing dividend yield of 5.14%. The share price has continued to surge since late 2020, following the rise in oil prices. The stock still appears to be undervalued, but may not be for long if oil prices continue climbing. Up next is Kimberly-Clark Corporation, ticker symbol KMB, and they are 8.3% undervalued right now, with a good dividend yield of 3.52% versus a trailing dividend yield of 3.22%. The stock crossed into undervalued territory back in April of this year, and has continued to decline in share price. Therefore, it is more of a bargain today than a month ago. On top of the attractive price, Kimberly-Clark raised its dividend this year by 6.54%. Up next is Chevron, ticker symbol CVX, and they are 9.33% undervalued right now, with a dividend yield of 4.93% versus a trailing dividend yield of 4.47%. Chevron, much like Exxon, has seen favorable share price appreciation associated with rising oil prices. It's not as big of a bargain as it was a few months ago, but still remains undervalued for the moment. Chevron did boost its dividend by 3.88% earlier this year. That helped raise its current dividend yield. Up next is Consolidated Edison, ticker symbol ED, and they are 9.92% undervalued right now, with a current dividend yield of 4.06% versus a trailing dividend yield of 3.66%. Comet has been undervalued since right about when the pandemic began, and has remained there since. The share price has seen some growth this year, and Comet has increased its dividend by 1.31% to help boost its yield. Up next is Atmos Energy, ticker symbol ATO, and they are 10.21% undervalued right now, with a dividend yield of 2.49% versus a trailing dividend yield of 2.24%. Atmos crossed into undervalued territory back in August of 2020, and offered a very attractive entry point in January and February of this year with an almost 3% dividend yield. More recently, the share price has appreciated, but the stock remains a bargain based on long-term trends. Up next is General Dynamics, ticker symbol GD, and they are 10.84% undervalued right now, with a dividend yield of 2.47% versus the trailing dividend yield of 2.2%. General Dynamics crossed into undervalued territory back in late 2019. In 2020, they presented a very attractive price and dividend yield of over 3%. The share price has bounced back quite a bit in 2021, but the stock remains a bargain based on long-term trends. They also recently raised their dividend by 8.18%, which is in line with their long-term dividend growth trends. Up next is Walgreens, ticker symbol WBA, and they appear to be 15.18% undervalued right now, with a dividend yield of 3.47% versus a trailing dividend yield of 2.94%. Walgreens has been undervalued for a few years now, but offered a really good entry point back in October of 2020, when the dividend yield hit 5.5%. While today's yield is 2% lower, it still remains above the trailing dividend yield. The stock has had 2 mediocre years of dividend growth, raising its dividend by 4.09% in 2019 and 2.18% last year. This year's dividend increase should come in July or August, so we will be on the lookout for a more attractive hike from them. And the last and potentially most undervalued dividend aristocrat is AT&T, ticker symbol T. They are 16.39% undervalued right now, with a dividend yield of 7.18% versus the trailing dividend yield of 6%. AT&T has always been a very high-yielding dividend aristocrat, but that is all about to change. The company recently made very critical announcements that will certainly impact its dividend going forward. Not all the details are clear yet, but a ton of uncertainty remains around the stock. There you have it, 12 potentially undervalued dividend aristocrats. Let's see how the undervalued dividend aristocrats from last month performed in terms of total return for May. And then I'll show you the 8 dividend aristocrats that are close to being fairly valued right now. The average return for all 15 undervalued dividend aristocrats from May was 0.57%. That is 1.88% worse than the return for Noble in May. Ben Franklin hands down had the best return in May of 14.03%. Hormel also had a decent month, moving up 5.06%. The poorest return came from Cardinal Health that fell 7.08%. And AT&T shed 6.3% last month, probably on the news announcement and investors moving out of their positions in the stock. Investing in undervalued stocks is definitely a long-term play, as it may take months or years to fully reap the rewards of investing in undervalued stocks. I will track a buy and hold approach portfolio, equally allocating a certain amount of money to all the undervalued dividend aristocrats going forward. And I'll compare how such a portfolio performs versus investing in Noble, the dividend aristocrat ETF. After May, the undervalued stocks are not off to a good start. Okay, let's move on and take a look at the 8 dividend aristocrats that are near fair valuation right now. Up first is 3M Company, ticker symbol MMM, and they are 0.81% overvalued, with a current dividend yield of 2.91%. The stock was undervalued just a few months ago, and still looks to be trading very close to fair value. Up next is Pepsi, ticker symbol PEP, and they are 0.83% overvalued right now, with a current dividend yield of 2.92%. Pepsi has been trading near fair value for a while now, occasionally offering more attractive prices. Up next is A.O. Smith Corporation, ticker symbol AOS, and they are 0.85% overvalued right now, with a current dividend yield of 1.52%. Similar to 3M, AOS was undervalued just a few months ago, but still trades near fair valuation. Up next is Cardinal Health, ticker symbol CAH, and they are 1.05% overvalued right now, with a current dividend yield of 3.3%. Cardinal was undervalued during May, but has trended back below its trailing dividend yield. Up next is IBM, ticker symbol IBM, and they are 1.56% overvalued right now, with a current dividend yield of 4.4%. IBM was undervalued last month, and also recently raised its dividend by a pathetic 0.61%. That was in line with last year's dividend hike of 0.62%. Up next is Ben Franklin Resources, ticker symbol BEN, and they are 1.97% overvalued right now, with a current dividend yield of 3.19%. Last month Ben was undervalued, and a few months ago they traded for a dividend yield of almost 6%. Up next is Johnson & Johnson, ticker symbol J&J, and they are 2.84% overvalued right now, with a current dividend yield of 2.6%. J&J has not been undervalued since November of 2020, and even the recent 4.95% dividend increase wasn't enough to push the stock into undervalued territory. And finally, we have VF Corporation, ticker symbol VFC, and they are 3.87% overvalued right now, with a current dividend yield of 2.46%. VFC has remained in overvalued territory for all of 2021. However, they are close enough to fair value that one bad month can push the stock to an attractive entry price. There you have it, 12 undervalued and 8 close to fairly valued dividend aristocrats. Come back next month to see how each of these stocks performs in June, and to see if any of the 8 fairly valued stocks move into undervalued territory. If you enjoyed the video, please subscribe to the channel for more dividend videos. Thank you for watching and see you next time.